Welcome to this Killik Explains Finance video. This week, why investors sell the wrong shares. We're good at buying, we're not so good at selling. Here's the evidence and what we should do about it. Now the background is what? Well, basically, there is an asymmetry between buying and selling, says Barry Ritholtz, well-known commentator in the US, on Bloomberg. Investors apply forward-looking, analytical, consistent processes to buying shares, according to him and a paper on which he based these views. But when it comes to selling, they're backward-looking and susceptible to human biases. In other words, we're systematic, organised, rigorous, all those things we should be when it comes to buying shares, but frankly, we're a little bit flighty and we don't pay much attention to it when it comes to selling. Now that's quite a statement to make, but it actually matters. So where's the evidence for all this? So the evidence is what? Well, basically it's from a paper called Selling Fast and Buying Slow, which I can give you a link to at the end if you like, from December 2018. So quite a recent paper, and it's quite a rigorous paper as well. It's put together by 4 eggheads, if you like, so 4 quite well-known institutions involved in putting this paper together. Again, more details on it available if you ping me an email. And the main findings are basically that investors are so bad in the institutional world at selling, they'd be better off dumping stocks at random than putting any time into selecting them. That's if they do put any time into selecting them. Crikey. So where's the evidence for this? How do they do this? So basically, how good is this study? Well, they reviewed daily holdings and trades for 783 big portfolios. Big, $573 million on average. So they looked at plenty and they looked at big ones. They evaluated 89 million trading points along the way with some computing power help, obviously. 4.4 million trades in total. That's 2 million buys, 2.4 million sells. So it's pretty comprehensive. And they cover the whole period from 2000 to 2016. Now that's not the whole stock market history, but it is a period that includes 2 big crashes and 2 quite sizable recoveries. So it's a decent spread of years and a decent amount of analysis going on underneath. And basically, the clever bit is this. So how did they reach the conclusion that these fund managers are not good sellers? Well, basically what they did, if you've read any Niall Ferguson, the historian, you know about this stuff, they put together a counterfactual sell portfolio. So what they did, they said, if we ran a shadow portfolio alongside the real one, if you like, during that period, and instead of selling the actual share, we pick a random one and just dump that instead, what does that do to the overall results over the same period? All right? And they repeated the process for buys, to be fair. So rather than buying what the fund manager bought at a particular time, they just picked up something random instead with the cash. Now, here's the results, and it's quite interesting. The randomized portfolio consistently underperformed the active one on the buy side. Conclusion, fund managers, investors generally, are pretty good at buying. They do better than you would if you just threw darts at a dartboard, if you like. But on the sell side, what they found was randomized selling generated a 50 to 100 basis point, 0.5% to 1%, extra return in just the next 12 months. That's a significant difference. So the conclusion has to be, from this study, that fund managers show a lot of skill when buying, but frankly, not a lot when selling. So we need to think about why that is and what we can do about it. Because if you're thinking this is just fund managers, I suspect it isn't. It's everybody. Now, why do we sell? And then perhaps we'll look at why we should sell, if you like. So, and this may seem familiar, gut instinct. The market feels toppy, let's dump some stock. Okay. Number 2, crude rules of thumb. The stock's up 20%, that's good enough, let's take some money off the table. Or, I've been excited by the next news story, need to raise some cash, haven't got any, dump something. Now these are all biases, if you like. In other words, especially the third one, excited by a new story, want to get into it, distracted by the new shiny thing, don't pay too much attention to where the cash is coming from to get it. Now, investors are prone to sell stocks that show extreme returns. Now this is more of the science. In other words, they looked at what stocks get picked off by fund managers and they found something interesting. They tend to pick off either the worst performers or the best performers, if you like. In other words, they were guilty of not running winners for long enough. So they'd say, let's sell one of the top 5 stocks in the portfolio on the basis that it's probably toppy, it's probably run its course, so we'll dump that one, risking not running a winner for long enough. And they tend to dump the cheapest stocks in the portfolio. It's already well saying, let's go for the bottom 5. Bang on a minute, aren't they also the cheapest? Are we doing this systematically, or are we doing it a little bit unrigorously, is the question here. The systematic selling of assets with extreme returns is costly, even relative to a no-skill random strategy, as Ritholtz put it. In other words, this might sound sensible, pick off the ones at the top or the bottom, dump those to raise the cash, but it actually doesn't work. Why we should be selling then? This is easier to say than to do. It should be a planned decision to reallocate capital. We should be identifying fundamental changes in circumstances and earning potential. We should be screening the whole portfolio, not just lazily going, oh, we'll dump some at the bottom or some of the ones at the top. Okay? So in other words, it's a rational rather than lazy analysis of outliers that will help reduce the difference between random selling and what's actually being sold. So how to get better at selling? Well, selling at the moment, in a lot of cases, is simply a cash-raising exercise for the next buying idea, whereas buying is an investment decision, selling is something else. In other words, there's an imbalance between the amount of effort put into buying and the lack of effort put into identifying stocks to sell. And there's hope here too, because by correcting some of these sell decisions, we could improve performance potentially by that half to 100, 50 to 100 basis points. So basically what people are doing is tracking absolute and relative returns for what they buy and hold. Buy and hold is done quite well. We should also be tracking the returns from selling decisions. Now people don't do this. They dump a stock and say, well, it's too late, I dumped it now, can't go back on history, no point in looking backwards. But actually, if we were to look at the returns we gave up by getting a selling decision wrong, painful though that may be, perhaps we'd learn about those selling decisions. So we should be as systematic and rigorous when reviewing stocks to sell, and we should put the same amount of time into doing so as buying, basically. Lots of ground covered there, editor@killik.com, and if you'd like a link to any of the stuff I've covered here, use that email address. And to watch videos on topics related to this and other studies similar to this one, killik.com/learn, and down this side, the shares tab would be a good place to start.